The oil shock did not stop at the barrel. It moved into currencies, reserves, rate decisions, and country balance sheets. The countries paying first are not always the ones ratings agencies have downgraded. That is the real question. Who pays when crude goes up? The answer is not one country, one price, or one rating action. It is a transmission chain. Higher crude raises the import bill. That creates more dollar demand. Then the pressure shows up in FX. After that, central banks decide whether to spend reserves, raise rates, accept weaker currencies, or lean on the IMF. That is why the FX screen matters. It shows the payer map before credit ratings do. The fragile cohort, including Pakistan, Sri Lanka, Egypt, and Bangladesh, lacks the domestic balance sheets to absorb higher energy costs, relying instead on official sector support. Bangladesh is the fastest moving case, transitioning from managing the shock to seeking new external financing. The mid-tier is the second proof point. India is absorbing the shock through capital outflows and currency intervention. Turkey is defending the lira with reserve sales. The Philippines is running rate hikes into an energy import shock. South Africa is partly offset by commodity exports. Indonesia shows how policy risk can compound an external shock. Australia shows that even a AAA-rated energy exporter is not insulated when fuel pass-through forces rates higher. Same crisis, different transmission channels. Then there is the other side of the ledger. Nigeria, Angola, Brazil, Guyana, US shale, and Canada are capturing price benefit and volume substitution outside Hormuz. That does not make the shock harmless. It shows that the crude bill is being redistributed. The ratings agencies have mostly held importer-side notches so far, but outlooks have moved, and exporter-side exceptions are beginning to appear. That distinction is the point. Same crisis, different transmission channels. One crude shock does not create one country outcome. It moves through different balance sheets in different ways. Ratings are not the first signal. They are the slower confirmation mechanism. This view is testable. It would be wrong if importer currencies recover and hold, Brent falls below 80, rating agencies turn positive on stressed importers, policy pressure fades. The FX screen is the leading indicator. The rating agencies are the lagging one.